All right, so welcome to one of our Forex League webinars. We haven't done these in a long time, but we wanted to just come back on. A lot has changed over the past year. We wanted to do this specifically for the beginners. We know that there are a lot of beginners that are joining our community. You guys are finding us on Instagram, on Facebook, on TikTok, wherever. And then you're ending up in this Telegram group, and there's so many messages, so many, different things going on. And we wanted to just kind of paint a picture of who we are, with Forex League, what we do. We've been at this, like we said before, for about 3 years now. A little bit of background on myself is I started trading around 4 years ago. And it's a funny story because when I first started trading, I was doing it like most of you guys, pretty much alone, right? Looking on Instagram, looking at other Forex gurus and stuff, people making supposedly a lot of money. That's why originally I got into it. I, like most people, I bought a course, went through the program, thought I was going to be a millionaire in like a week. And then, the harsh reality of trading kind of sets in. And then you either give up or you go on this like crusader path, towards actually making progress and becoming profitable. Lucky for me, about 1 year, or actually I think it was less than that, maybe less than a year in, I actually met Nick. Most of you guys probably know Nick from Instagram because he has the much larger page. And Nick had already been trading for a good amount of time compared to myself, and we were able to connect. We happen to live near each other over in New Jersey. That's where we're based out of. We were able to connect, start to share ideas, and then that's kind of how I started really progressing within my own like trading journey. And then also it's kind of how Forex League was born. So at this point, we've been running Forex League for like 3 years now. Nick will get a little bit into his experience, but without going too into detail, that's just a little bit about myself.
Yeah, and I'm gonna generalize too, because I mean, there's a good amount of things that have happened along the way, but very similar to Angelo. I started learning about trading because I saw on social media there were these lifestyle traders, not that many at the time, because again, I've been trading for 8 years, so this was quite a while ago. But more importantly, there were no communities, so I was trying to find a mentor really hard, and I had to go through the old way of trial and error, just kind of learning and figuring it out. So it took me quite a while, with the absence of a community or anything. But probably around year 4-ish into year 4 for me of trading, I met Angelo, as he said, the birth of Forex League, because that was a huge problem, right? At the time, there were no real great communities that kind of encompassed everything from psychology to trading to, everything else. That was kind of the vision for it, right? I mean, that's why we started it. We really wanted to encompass everything and create literally the best community for traders.
And in the beginning, we were a part of a bunch of different communities. Like most of you guys, you're probably in like 10 different telegrams, and we were sitting there and we were like, what can we do to how can we bring the best out of each of these groups that we're in, each of these courses? I had been a part of a program that was like very popular, that people were getting some results from, but like they didn't even teach, for example, like how to calculate your lot size, right? They weren't even teaching how to do risk management. They weren't even talking about back testing. So to us, from the background that we were coming from, me and Nick both, got our bachelor's degree, graduated from college. I think you did like international business, right?
Yeah, global business was my major.
Something like that. And then I actually did IT and economics. So we had a more like professional kind of background. We were like, how can we create a program that is very structured, that can actually kind of put people on to treat trading more like a business, right? So as opposed to open an account, upload $1,000, risk the whole account, blow your account, repeat, right? That's what a lot of these groups are preaching. They're like, oh, start off with a small amount of money, make a lot of money, and then, you're either going to be rich in 6 months or you're going to be dead broke, right? So we were like, there's a lot of this going on, and it's really sad that people are kind of, putting across this messaging to everyone that's out there. It was just really crap, out there with what people were telling everyone in regards to education and the Forex community. And originally we did just start with Forex. So we were mainly focused on Forex. Obviously, for people that have been in the industry the last couple of years, it has kind of progressed now and expanded in, Forex, commodities, and like gold and everything was always there. But indices have become definitely very popular over the last year or so, the last 2 years. And then now crypto, obviously over the last 4 years has become prominent, especially in the last year. And then a lot of people are now starting to margin trade crypto as well. So originally we got into it, we're just trying to make a great community. We had no plans to start funding, traders and all that. We'll get into that in a second, but pretty much to this point, our goals remain the same. Our vision is to make the best trading community possible for our members. And we originally set out for it. Our intention was we want to meet other people that know how to trade. We saw the power in connecting with other traders, just from myself and Nick connecting and how it helped us. So that still remains kind of the foundation of the Forex League brand and community to this day. So let's pretty much get into it. The first topic that we're going to cover is just funding. Overall, what is funding? For you guys that are beginning with trading, 4 years ago or so, when me and Nick were trading, we didn't have the opportunity to get funded, right? When you first started, no idea.
No, yeah, you had to grow your own account from scratch or whatever you were putting in. There was no such thing as funding opportunity unless you were like some crazy, well-renowned trader who's privately trading millions of dollars for other investors. Other than that, it really didn't exist. The opportunity, anyway.
Yeah, the only thing that I can remember was I was thinking, if I put together an FX book, for 1 to 2 years, and then at that point go and contact investors, potentially would be able to get investment. But that was like a long shot compared to, what everyone really was doing, because most people didn't even use FX book, you know what I mean? So
it was so new, and it was definitely like a long-term plan. Like there was nothing immediate where you could have access to money. It was so totally different than now.
So funding has been pretty transformative to the community. I'd say around 2 years ago is really when it started. And just what is it in a nutshell, right? Basically, a lot of these firms, what they're doing is if you are able to pass a two-step challenge for one model in particular, there's a bunch of different firms out there and a bunch of different models, but we're going to focus on the most popular one. So basically, if you pass their two-step evaluation, they will fund you with their live capital, and then you will be able to get a profit split on that live capital. And that can range anywhere from $25,000 that you're managing to $50,000 to $100,000, $200,000, all the way up to $400,000. So you guys can go from paying what would be the sign-up fee, which is a couple $100, all the way up to $1,000 for the largest accounts. And then you can end up managing what would be a $400,000, $200,000, $100,000, $50,000 account. Now you might be thinking like, oh, that sounds like almost too good to be true. And it like almost is, right? It's like crazy that you'd be able to sit in your house, literally not have to go anywhere. And if you show that you have the skill level to perform, people will give you money. But it is true, right? They're available. There's many firms that are out there. Me and Nick have been blessed at this point to be able to be a part of one of them in particular. Most of you guys probably know about it, the Funded Trader. But yeah, pretty much we ourselves, someone asked, do you think guys funded will end? So we'll answer questions at the end. So just post any questions you have in here. But me and Nick's background with the funding challenges, as we particularly were trading with FTMO. At one point, we were actually passing challenges for clients that want us to manage it for them. So we do have a history of trading with prop firms, specifically with FTMO. And then it progressed to the point where we had the opportunity to start our own prop firm, right? So we had the opportunity to partner with investors, and basically through our Forex League community, we are now finding traders from literally all over the world, all over the place, because everyone's pretty much eligible to get funded. So it's been a wild ride to get to this point. More information on the funding will come later in the call, but I'm just going to go ahead. I want to just run through this video really quickly. That kind of explains everything.
Welcome to the Funded Trader. Are you ready to take your trading to the next level? The Funded Trader was made by traders to offer an opportunity to manage large amounts of money. We let you combine your skills with our money. Our traders must pass one of our simple challenges to get funded. Phase 1 of the challenge is 35 days long and consists of the following rules. You must open, close a trade on 5 separate days. You cannot lose more than 6% of the account on any day. The account cannot go down 12% total from initial balance. If you follow the rules once you achieve 10% profit on the account, you will pass phase 1 and be sent a new account for phase 2. Phase 2 of the challenge is meant to be a verification of the excellent trading you showed in phase 1. You will have 60 days and must follow these rules. You must open, close a trade on 5 separate days. The account cannot lose more than 6% on any day. The account cannot go down 12% total from initial balance. If you follow the rules once you achieve 5% profit on the account, you will pass phase 2 and become a funded trader. Once you pass phase 1 and 2, you are officially a funded trader and will receive your account to begin building your kingdom. Traders who show consistency are given the opportunity to scale their accounts up to $1.5 million. Contact us by email or 24/7 live chat support to learn more. Funding available for experienced and aspiring traders, ready to scale up on the professional trading journey. At The Funded Trader, we believe every retail trader deserves the opportunity to raise capital based on their performance and commitment to building their own business.
All right, so that's pretty much it in a nutshell. As part of being in the Forex League community, we will obviously educate you a little bit more on how to actually get funded, how to get started, how it all works, because obviously we're answering any questions that are inside. But if you did want to just go to the website, the goal for everyone, if you are a beginner, and it might seem out of reach, or it might just seem a long ways away, but the goal at this point is definitely to go for the funding challenges and to inevitably get funded, right? Because if you don't have a large amount of capital and you get funded, all of a sudden you're managing. So yeah, let's get into next. How long does it actually take to become profitable? So this question obviously is a little bit different for everyone. For myself, it took around, for me to understand all of the concepts and to get to the point where I can actually make money in the markets, I would say it took me around 2 years, around 18 months or so, to actually get profitable and to be fully confident in trading plan and all that. What about you, Nick?
It took me a little bit longer, actually. And I think a lot of that was due to, also being by yourself. It took me about 2.5 years, maybe a little bit longer, before I actually got profitable, right? So it was a pretty long journey. And it also really depends on what you put in, right? So what you put in is what you get out. And that couldn't be more true with trading. It's going to vary with everyone.
Yeah. And I think, like Nick said, a big part of the reason why it took that long, and obviously we're just being brutally honest here, is we definitely feel like not being part of a community where we're kind of bouncing ideas off of other people and just literally holding ourselves more accountable, definitely prolong this process of learning. Because it's almost like kind of going to school for something, right? If we were to tell you you go to school for trading, after 4 years you can learn how to make money, from wherever, obviously, you would sign up. But most people hear me and Nick just say it took us 2 years to figure this out and become profitable, and they're probably like, wow, that's a long amount of time, right?
Yep.
But I will say, if you are part of a community, if you're able to bounce ideas off each other, if you have the structure and the right coaching, it can definitely bring that timeline down dramatically. But we're not going to sit here and just outright say, you're going to learn in 2 weeks. It's definitely going to be difficult, because it's one of the hard, at the end of the day, making money in the market is one of the hardest things to do, because it is literally 80% psychological, right? We can teach you all the fundamentals, all the basics in a couple of weeks, but when it comes down to mentally being prepared to make money from your phone, from your computer, it's not an easy thing to do. It's not an easy thing to realize that you have access to making all this money, especially with the funded accounts now. It adds an even thicker layer to this psychological.
Absolutely. And that's another thing that kind of plays to the timeline of your own progress, right? Is some people are more prone to feeling emotions from market reactions, and some people are better with coping with that. So, that could, add a little bit more time to your, journey towards profitability as well. But, it definitely varies. But a community help. I've seen some traders, again, this is uncommon, but I've seen someone go from knowing nothing about trading to profitable in about a year. That's definitely way below the average. I'd say the average is probably 1.5 2 years.
Yeah.
But you know, that guy was an absolute savage, you know, every day on the chart, multiple hours, just, and was already, you know, coming to trading with a pretty good mindset. Again, not the norm, but it's definitely possible to become profitable in a, I would think, is a relative time frame. You know, 2 years if you compare it to school or, you know, something else where you're going to get a degree, it's usually 4 years, you know, if not more. So I actually think
Right.
trading, you know, it's pretty good. It's not that bad of a time frame if you take it seriously.
No, yeah, if you take it seriously and if you have the level of commitment, right? These people that are getting to the point where they're successful much faster than the average, they obviously have another level of commitment and they're really taking in all the lessons that we're teaching, that other people that they're talking to who are successful are teaching them, and they're not just letting it go in one ear and out the other, right? They're actually creating some sort of methodology for them to follow these practices and to put them into play and to actually help them become better. Because guys, if you're just literally reading things and you're not actually creating some sort of method to the madness of doing everything, it's at the end of the day, it's like a waste. It really is a waste of time, right? Like if nothing changes, then nothing changes. We could give you all the information in the world. We could give you the best programs. We can connect you with the best people. At the end of the day, if you're not holding yourself accountable, if you don't have the discipline to follow what we're teaching you, it's going to be a long and winding road. And we see that with some of our members as well, right? Some people that come in, they put their head down, they focus on the material, right? They don't make excuses. They face the facts, which is the reality that it's going to be hard. There's going to be a lot of failure, and they have to learn from that failure and inevitably become better. And then they have these small little breakthroughs. And then over time, as they look at themselves, maybe 1 year in the past or 2 years ago, they're like, wow, I've changed dramatically. And it's because I held myself accountable. I remained committed, right? And I had that discipline. And then there's people that come in within 2 weeks, 3 weeks, they start messaging me and Nick. They're like, I can't get this. Like, I have no idea what I'm doing. Like, I'm going to fail. Like, I'm a failure. All of this negative talk, right? That's really all that it is. Even to this day, Nick and myself, like, we fail on things. We lose trades, right? We lose trades. We fail on different businesses, different ideas. Like, there's never going to be perfection in what you're doing. And you just kind of have to face that fact if you're going to get into trading, if you're going to get into business. That's just kind of the reality of the situation. Is it's no risk, no reward, right?
Yep. Yeah, well said. No, you killed that. Couldn't have said it better.
Yeah. So yeah, what we're trying to get at is don't be that person that joins a program, a course, reads a book, meets someone, and then points the finger at other person for you not benefiting from whatever that is, right? Hold yourself accountable. If you do, like I promise you, and I've seen it time and time again, if you do hold yourself accountable, if you do have discipline, if you do remain committed, you guys will come out on the other side and you will be successful. So that being said, what do you guys need to get started? We've obviously preached about our community, everything that's involved in this. We'll get into that later in the call, but in order to get started with trading, it's pretty simple. There's only a few applications that you actually need. One, we use TradingView. So you're going to need a platform, and we're going to hop onto this in a second here. But basically, you're going to need a platform where you can actually do your charting on, which means you can actually mark everything up, take a look at what's going on in the markets, right? Make your decisions, everything like that. And then you're basically going to need a platform that you're actually going to execute the trades on. So that's all inside of the program that we teach, but basically it's what it's called is MT4 or MT5, or there's other platforms called C-Trader as well, which are a little bit newer, a little bit more advanced. And those platforms, you'll be able to open a brokerage account, you'll be able to deposit your money into a brokerage account, and then you'll actually be able to take trades. Or if you go the route of literally just trying to work with funding companies, not even funding your own account, which you don't have a lot of money, I honestly would recommend you go with the funding challenge. They send you an account, you get the brokerage login details, you log into the platform, whichever one they're using, and then you can enter trades on that. So you don't really need much to get started with this business. There's not a lot of overhead at the end of the day. And that to me was one of the things that it was the most attractive in the beginning, was the fact that you don't have to buy inventory, you don't have to buy office space, right? You literally just need Wi-Fi, you know, preferably a computer. There's some people that sign up for the course that just have phones, and I would honestly advise against that. Again, if you really want to take this seriously, get a computer so you can actually get on there and do some charting time. That's not to say that you can't chart on your phone. I'd say once you get to a more advanced level, you should probably avoid that. You can't do any of the back testing, you know, just on your phone. So definitely advise like having a computer. It doesn't have to be the best computer in the world, right? You could get a computer these days for like 200 bucks, 150 bucks. That would be sufficient. And then, yeah, you get on TradingView and you can get on there. So that being said, that's all you need to get started. Let's pretty much get into like an example of a trading strategy. So all me and Nick are going to do is we're just going to cover some lessons on beginner type topics. These are just kind of the foundations of trading here. So we're going to cover market structure, supply and demand, price action, Fibonacci, and then kind of looking at multiple time frames. And then using all of these things is how you can kind of put together and build a trading strategy. So I just want to remind you guys, post in the chat one question. We're going to do a Q&A at the end of the webinar, and you're going to qualify for a giveaway just by posting in there one question. So I'm going to go ahead, I'm going to get set up on TradingView. All right, so the first topic that we're going to cover here, I'm going to just hop onto a random chart. We're going to just remove all this. So the foundation of literally everything, guys, is just market structure, right? For you guys that are more experienced, you've probably seen this time and time again, but pretty much what the market's going to show us, I'm not even going to look at the market yet because there's literally no point of actually looking at the market until you start to understand like these basic concepts. But basically what we're going to have, guys, is downtrends and uptrends, right? So downtrend, we're going to have these lower lows, so it's just lows in the market, lower highs in the market, lower lows in the market, lower highs in the market, so on and so on. This is going to continue to make a downtrend. And this just means that the market is trending. It's in a healthy direction. Let's go here. And pretty much we are not going to consider this an uptrend until one of these subsequent lower highs are broken, right? So we've gone over this so many times on the webinars. We literally have so many calls with the members going over this one simple topic. And we just tell them pretty much until this sequence of events is broken, we are going to continue to take trades, and we're mainly going to be looking to take positions at these lower high points, right? So this is just a very, very basic concept, and this is a downtrend, right? So on the flip side, obviously, is an uptrend. And in the uptrend, we're going to the upside. We've got these higher high points, these higher low points right here, boom. In a lot of cases, they're retesting these previous highs, and this is, again, just a healthy trend. So what happens, right, when we're in a downtrend? Let's go ahead and take this off. And then all of a sudden, we get a break of this level, right? So as I'm in this downtrend, I'm thinking to myself, I am not going to consider this an uptrend until this level is broken. Every single time we're making these higher low points and we're moving down, I'm looking at this level and I'm like, until this level is broken, we are still looking for sells. So as price is moving up, moving up, moving up, moving up, still looking for sells, still looking for sells. Again, we can get into some more intricacies of this, but we're going to keep it just super basic for right now. And then all of a sudden, we have a break of this level. So this is telling us that a price at which the market moved off of pretty dramatically and made a new low. So whatever price this is at, 4,700, we'll just call it, the market decided to actually find enough sellers to push this to a new low point. This is why this is a pretty significant level for us. Again, just very hypothetical. Then all of a sudden, price moves up, we break through this 47 level, and we actually make a new high point here. So whenever this happens, what we're looking for is a reverse of a trend, and then we're looking for the first higher low point. So the market could retrace all the way down to this level. It could retrace all the way to the bottom here. As long as it makes that first higher low point above this previous low right here, then we're establishing a new trend, and then all of a sudden we have this going on. So we're forming these new highs and these new higher lows and the trend has transitioned from a downtrend into an uptrend. So we're gonna go ahead, we're just gonna label some of this right here. So we've got these lower high points and then to the downside. And when you're just starting off, it's good to label this all out. Like when I was way in the beginning and I had no idea like what the hell I was doing with any of this, I would literally come on the chart time and time again, and I would just mark all this out. I would get in my chart time. I'd focus on, one lesson at a time, and I would just literally mark this so I could get a visual as to like what's going on. That's exactly what we're gonna do right here. So we've got this new higher high, this subsequent higher high, and then we've got, so this right here is really just the basis of market structure. Market structure is king. Market structure is in my opinion, along with supply and demand, are the number one and number two things to really learn about the market, because they're just kind of telling the truth. They're telling you where the market stopped and moved. They're telling you prices at which the market stopped at. They're giving you levels. They're giving you support and resistance, right? So understanding market structure is definitely going to be key if you guys do want to become profitable and really take this thing seriously. So we're just going to call this is a downtrend to an uptrend. And remember, in this sequence of events, in a downtrend, we're looking to take our sells in these highlighted zones. So we're just going to call this a sell zone. Call this a sell zone. And then on the flip side, we're going to be looking to take buys in these areas. So whenever we make these subsequent higher lows, this is specifically where we're going to be looking to take buys. We're not trying to take buys at the top. So many people like make mistakes with this. We're not trying to buy up here. We're not trying to sell down here, right? You're not trying to panic sell when it's just plummeting. You're trying to wait for the pullback and then wait for it to go lower. Wait for the pullback, waiting for it to go lower. Like a lot of people, specifically right now with crypto, they see crypto going up, right? They're getting super excited. They want to get in. It's up 20% today. They're like, wow, I'm gonna miss out on like another 20% gain. Let me buy the high. Let me, visualize to you guys where you're buying. You're buying here. Then the market crashes 20%, boom, boom, crashes 30%, crashes 40%. You bought up here, you lost all your money. This is the point at which you should be buying. Now everyone has fear about buying because they're like, oh, things aren't bullish. This could then go down all the way down here. No, this is when the smart trader actually gets in, they buy on retracement. That way they're able to maximize their reward, because if you look at it like this, the market moves up 150% from that level all the way down here, as opposed to, say you bought here, you went into drawdown 50%, maybe you held, and then you did make a modest 25%. You're missing out on all of this. You're missing out on this whole gain down here that you could have made just from actually buying at a better price point. So again, this is a downtrend to an uptrend. On the flip side, this is going to be an uptrend to a downtrend. So let's go ahead and just simplify this for you guys. This is a higher high, that's a higher low, higher high, higher low. And then we have a break. Again, can retrace all the way up to that level. And then this establishes a new trend to the downside. And it's literally just the same thing that is mirrored right here. So on the flip side, this is where we're trying to be buying once it's in the uptrend, same thing that we did above. And then this is where we're trying to be selling once we hit on the downtrend. Now, you can go ahead, I'm gonna just continue to label this out. Now you can go ahead, once you do get to the point where you're a little bit more comfortable with these concepts, you can actually go right onto the chart. This isn't just like the land of make-believe here. You can just take this concept, this exercise, and you can go onto the chart and you can run this all day to build confidence in market structure. So let's go ahead and actually pop on. I'm just gonna leave this as a visual if anyone wants to see it real quickly, screenshot it, whatever. If you haven't heard of this before, if it's a new concept for you, if we went a little bit fast, don't worry, we can continue to go over this time and time again. But again, this is just a basis, and let's just label this. This is market structure 101. We'll call it market structure 101. So if we come up here, we just come onto a chart. We're all the way on the weekly time frame. We can come down. We can see the market's clearly in a downtrend. Right here, we won't even zoom in. But without getting too much into it, we basically can identify some lows. We can mark some things up here. And this is what we recommend to everyone inside of the course to do, is to do an exercise much like this, just to get a hang of what's going on. So you can go ahead, you can trace this whole thing out, and then you can go ahead and hide this, and you can come on here and see, all right, maybe clean it up a little bit, but you can just run through. You can just start from the left. Where's this first lower low? We have first lower low here. We have a lower high here. And then what happens? We have this higher low. We have a little break of structure. We have the first higher low. We could have definitely taken a buying opportunity on this, right? If we were to get into it a little bit, that's where we would want to be buying. Same thing as we said before. We have this previous low. This was tested, and then all of a sudden it moves up. And then what happens here? We have a break. And then, so this is happening. Obviously, it gets a little bit more advanced right away, but this is happening just over and over and over again in the market. We have this break of this previous low right here. We form a new lower low. We're waiting for that first lower high. We're making sure it doesn't break this previous high right here. This would be our first opportunity to sell right there. And then what happens? We also have a subsequent support level form. We have another lower high, so we could have sold again here, so on and so on. And this thing continues to form these lower high points. So these are all areas where we could be selling. Because remember, we're not going to sell at the lows. We're waiting for the pullbacks. And then what happens here? We have a break. So we break the lower high. We form a new high. We're looking to buy at the first higher low. So maybe we bought right here. And then what happens? The market's not always going to run, exactly like it's supposed to. We bought here. It came up. Maybe we had a little bit of a gain on our position. Came up a little bit, maybe it came up 1%, 100 pips, whatever. And then all of a sudden we push down, and then we break support again. And then the cycle continues over and over. So that's just a quick example of a downtrend. And then obviously if it broke and then went up into an uptrend, that's when we would have that transition that we were talking about just in our example below. So one more time, let's just go ahead, come back up to this weekly. I don't know where all this went. Here we go. Let's zoom in a little bit. I don't know where that went. Or whatever. But that's what we're going to cover in market structure. Here it is right here. So again, this is just the overarching example. We could go on and on and on about this topic over and over again. But the point is, literally within the span of 10 minutes, we drew out the very basics of it. We got onto the chart. We started to implement what the basics were in comparison to what the actual market does. That's how you can kind of get right into it. So that's market structure. Let's move on to demand. So do you want to do it supply and demand, or do you want me to do it?
I think the first two were yours. I'm doing
I'll cover supply and demand as well. Let's see this. All right, so supply and demand is a pretty popular, I guess you could say, form of TA that people use, technical analysis that people use to take advantage of the market. Pretty much what it is, and we're going to build off of the market structure lesson. So we have this uptrend right here. So we're forming these higher highs and higher lows. So our demand zones are always going to fall in the beginning of these swings in the market, right? So we have this push to the upside when the push started, where price has not previously retraced to. So this is going to be a demand zone. And then this is going to be a subsequent demand zone right here. And this is going to be a subsequent demand zone right here. On the flip side, the supply zone is going to be at the top. So whenever we have the market hit a new high, much like this is when we're going to be drawing these supply zones right here. And just to like put this in layman's terms, the way that I really look at this concept is basically when price moves dramatically from a high point and forms a new higher low or forms a new low or whatever, and it doesn't come back to retrace this previous high, right? For the upside, it's called supply zone, right? So this is just when there was the most supply in the market. This is when sellers stepped in, moved the market from whatever price this was at 62, in this example, 62. So this is just a very strong selling price where more sellers stepped in than buyers and drove this market down. So when price comes back to retest this area, it is very likely that we're going to see rejection from this zone, right? It's very likely that price is going to come back here, up here. Sellers are going to say, wait, hold on 1 second, right? We previously looked at this level as a great price to sell at, and we're again going to agree that price is going to equal out. We're going to hit some equilibrium in this area, and then we're going to show rejection, and we're going to push this thing back down to the downside. Now, on the flip side, it's literally the same concept if we are talking about a demand zone down here. So at the bottom, price concludes that down here, more buyers than sellers stepped in, and it's not about like a little bit, like a ton of buyers and sellers stepped in this example, this 2900 area, and then decided for price to push up to form a new high point. So it's very likely that if price comes back to revisit this zone, it's probably going to reject this area. And if it doesn't reject this area and goes through it, it'll most likely retest and then reject to the downside. So it all comes really back to market structure, right? So this is a concept that's building right upon market structure. So it's like learn market structure first, learn supply and demand second, and then you can kind of build the building blocks of a strategy. So in order to actually draw these zones on the chart, you're going to have to understand like candlestick patterns a little bit more. So we're just going to go ahead and draw some price action patterns on here. So first we're going to have a little bullish candle here. We'll go ahead and color this one green, and we have this followed by. So if you guys have really never seen a chart before, this might be the first time that you guys are actually seeing like a combination like this. If we were to just go ahead and actually zoom in on the chart up here, you could see these all day with bullish candles, bearish candles. I have them colored in like blue and white, but literally this is all you're going to see on the chart. You're going to see this bullish candle, this bearish candle. What this is just a bullish candle, bearish candle. This is the classic bearish engulfing. You're going to have many different variations of this. So that's going to be a bearish engulfing. You're going to have what's called an evening star. We're just going to do 2 for each. So this would be bearish combinations right here. I won't go ahead and draw this, but basically we have this little doji candle. And this is probably like, what would you say, like one of the hardest parts of learning is kind of just memorizing all of these?
Yeah, it's being able to really read price action and what it's telling you. And being able to identify, like that's the next section we're gonna get into, price action. I'm gonna show you guys pretty much the 3 things I look for in every single candle to then clarify if it's worth entering on or if it's low volume, etc. But it could take some time. This is definitely one of the things where you need to spend a lot of time on the chart to be able to kind of identify with the like almost second nature, you know?
We're not going to get into patterns too much, but the reason why like we're going over all of this stuff is, yes, there's a lot to cover, but it gets to the point when if you can learn all of the concepts, right? You know everything like it's the back of the hand, you know all the price action combinations, you know all the patterns, everything like that. When you're looking at the market, I remember I just know the first time people see this market, see these charts, literally everyone says they're like, this is like literally like looking at the matrix, right? It's like, what the hell is going on this? But then as you learn all of these different concepts, at some point there's a serious method to all this madness, and you just realize like, all right, I can have a little bit of confidence while looking at all this.
Yep.
All right, so this is.
But yeah, it's like a foreign language the first time
my best
you come across it. Oh, this is good. This is nice.
So it's nice. So here we have bullish engulfing. This is just massive. So bullish engulfing here. We have bearish engulfing here. And then you're gonna cover, right, do some price action stuff.
Yeah, I'm gonna do the basics of price action. And again, guys, that's something that we could spend, hours finding examples over and then talking about it and, applying our different logic behind it. So to keep things, efficient, just gonna give you a basic knowledge, but we do cover these in all other, sessions quite a bit.
Yeah, so just looking at this, the reason why I'm putting this on is in order to actually put on your supply and demand zones, you have to kind of know like some bearish candlestick combinations, some bullish candlestick combinations. Because if we just come up to the chart up here, we're all in the weekly time frame. Normally, I would advise to actually use the supply and demand zones on a lower time frame. But for the sake of example, we're just going to come on here and just take a look. And remember one more time, like down below, as we said, I actually deleted this off, but we're going to be marking our demand zones down here, and we're going to be marking our supply zones up here, right? And this example is an uptrend, but we can mark these all day. This is all in the weekly time frame. We're just going to look at, let's just pretty much look at this little trend right here, right? So we've identified a downtrend in the market, and by downtrend, I mean we're making these subsequent lower lows, boom, lower low, we have this lower high right here, we have a new low, yada yada yada, right? So where the hell do I draw these supply zones? When do I draw these things? Remember, in a downtrend, we're drawing them at the lower high point, which is going to be right here. So price just made a new low, we're on this pullback. Now what are we looking for? We're looking to see where does the price actually reject and then move down to make a new low point, right? So that would be this leg right here. This is when price breaks the previous floor and moves down and makes a new low. So we would go ahead and we'd look at the top of this and we'd say, where did this start? Where was the candlestick combination that we just marked down below? In this example, we're actually looking at an evening star combination right here. And then I would just draw from the wick of this bullish candle. This is when the reversal started. So we had bullish, we had this doji, and then we had this bearish candle. I'm gonna go ahead and clean this up in a second, but I'm gonna actually drag this across and I'm gonna move this down to the body of that bearish candle when it closes. We'll actually go ahead and mark this up in red. So price came down or came up, made this lower high point. We pushed to a new low. Now, when are we trying to take advantage of this? We're trying to take advantage whenever it retests this red zone, right? We're looking at for price when it does come back up into this red area to retest it and to show rejection and then move back, towards the upside or to the downside in this scenario, most likely. And as you can see here, price came up, we rejected this area, we had one rejection. This is most likely based on news. So this would have been a little bit hard to actually catch on this. But anyway, we had this rejection in this area. And you can do this in combination with so many other things. Obviously, we just drew a supply zone up here. This is a previous lower high. We could bring on some additional tools to give us some confirmations. We could drop down to like a lower time frame and look on the lower time frame what's actually going on, because right now we're all in the weekly. So say we came down, we actually can't come down to the lower time frame, it's too far back. But say we did come down to like the 15-minute, maybe we're monitoring this zone and we can actually see some sort of breaks of structure or some sort of other reasoning for us to actually take advantage of this move. A better example would actually be right here. So again, we're looking at a downtrend. So the price is forming this new low, we have this lower high, boom, and then we're kind of just bouncing. And then all of a sudden, price finally breaks this floor right here. So we have a break of the support level. We form a new low. And so at this point is when we're going to actually mark down a supply zone. So we're going to come to the first point at which it started to make this hike down. That would be at this point. We have this bullish candle, and then we have this bearish candle. The body actually closes much lower. We're going to drag this across, and then I'm just going to come back to simulate if we were actually at this point in price. So as price comes back up in this red zone, I'm thinking to myself, I am looking for sells. This is the point at which price rejected. Previously, we moved dramatically to the downside. This pair actually moved about 1% to the downside, which is a lot, about 120 pips. So I'm looking for sells in this area. I'd come down to a lower time frame. I try to start to justify getting into a trade in this zone. We could bring on some other tools here. There's multiple ways we can go about this. We have trend lines. We could also identify patterns. So like one pattern in this area would actually potentially be like a head and shoulders pattern. Hold on, let me draw this out. So we have like, this is the left shoulder with the head, and also in price coming down. Maybe we look for the right shoulder up in this area, and then we're looking to like actually enter on this on the break of the neckline right here. So we can use patterns, we can use trend lines, we can use breaks of structure. There's so many things that we can do to take advantage ultimately of this trade. And if we just let it play out a little bit more, you could see how many times it actually retests this little red zone. So it comes back up again. I guess it floats up. It comes to the 4 hour. So
Failed pattern.
Yeah, failed pattern. But anyway, we can see it rejects this red zone. We could have got in on a little trade on that one. And it comes up, comes down, blah, blah. We could just flip this again if we want to do. That would be an example of a demand or a supply zone. And on the flip side, what if that fails, right? What if we have a failed pattern? This thing moves to the upside. Now we can mark down an actual demand zone. So it's the same thing. Price makes a new high point right here. We're going to go ahead and just mark this. Right here is our demand zone. So same thing we did last time, just on the reverse. We're going to look for the wick of this candle. We're going to go to the body of this candle. We're going to drag it across. We can see price came down, tested the zone. We can come down to a lower time frame. We can look in this area for methods to the madness. We could say, oh, price did a double bottom, rejected this area twice. We have a bunch of wicks. We could wait for the break of resistance, and then we could get in on some sort of buy in this area. So there's so many ways to go about leveraging supply and demand. It's good to pair it with market structure. And like anything else, like you guys just saw, it's not always going to, work perfectly, but that's the point of all of this, right? That's why trading is very psychological, is you don't have to be right all the time in order to make money in trading. And that's kind of the paradox behind all of this. So
right.
We're gonna go ahead, we're gonna move into the next topic here. Nick's gonna cover some price action and then some fibs. We're gonna leave off multiple time frames just because we are running out of some time here. So I'm gonna go ahead, I'm gonna give you the ability to share. And then again, if you guys have any questions, write in the chat any questions you have, because we're gonna jump into the Q&A shortly after Nick finishes up with his little lesson here.
Right. So the point of all these concepts is we use them together, right? To try and increase our probability in the market. And it does most of the time. That's why we have a proven strategy. That's why we can make money from trading, right? But it's not always going to work out that way, which is why it's so tough psychologically, right? There's always going to be losses here and there, and you have to know how to cope with that and how to minimize those losses. So that's really the whole point of all these concepts and what we're doing. So this is going to be a price action lesson, and we're not going to get too deep into it. I just want to pretty much show you guys what I look for when reading price action. And there's really 3 ways that I differentiate these candles. So first one's going to be conviction. So these are candles with good volume. Usually these are going to be entry candles once they're coupled together. 3 of these in a row after a major reversal, after a pattern, if we're at a supply area or supply zone, that's all going to come in handy and count as confirmations for us getting into a trade. So these are my favorite conviction candles. So little to no wick, and then conviction in the direction that it's pushing. So this is a bearish candle. We have a little bit of a wick here, little to no wick on the downside, but a good sized candle. Okay. And then same for the opposite for bullish, right? Little to no wick to the upside, some rejection on the downside. So these are really powerful. One great example of these are engulfing candles. So Angela just covered both a bullish and bearish example for that. And oftentimes they are great entry candles. So that's conviction. The second is going to be indecision candles. So these are low volume candles, essentially. This is when you see no movement in the market, when we're at resistance or support and price action seemingly just going sideways. Okay, there's really no entries there. That can be kind of an indication that something is coming, that a move is imminent. Whether it's going to be a continuation or reversal, we won't know. We'll have to wait until we see those conviction candles, and then either how the reaction of price action at either level is. So indecision is just something to be aware of, to be wary of, right? There's no entry on this. A lot of people will enter on indecision candles as soon as we reach a key zone, thinking that it's the right entry when it's not. So beware of indecision candles, better known as dojis. Okay, and then the third set that I look for is rejection. So these are candles with long wicks. Okay, and this means that half the battle was pushing up, half the battle was pushing down. There is no direction here yet. Now, if you get two of these, in a row, followed by some conviction candles, let's say this guy was like down here, we get a little tweezer top, huge rejection off resistance. Again, you're using other confirmations, other concepts to strengthen the probability of this trade, right? So we see that rejection, then we look for the follow-up candles, and then we enter on those. Okay, but rejection is super, super important because this can actually tell you a lot. There's often a lot of volume if it's a good sized candle. So that could mean that an entry is coming, if the volume sustains, then you just need to see which direction, it plays out in. So patience pays in that scenario. But a great example of rejection is just exhaustion, which is just tons of wicks into a zone or an area, or tweezer tops, which is actually pretty much like a full setup. So you have a bullish candle, rejection, then it starts off as a bullish candle, rejects, meets the same high, and then goes bearish. So this is often a really great reversal signal. Again, this is just kind of the analysis of each candlestick itself. When you put these together, they create patterns. So look down here, price action turns into patterns, which helps us identify entry opportunities. And then two things to note is avoid consolidation. So a whole bunch of these guys, or don't enter on low volume. Also that. You only want to enter on conviction candles. Okay, as they're playing out. Okay, so let's just go through the absolute basics real quick on how to identify these candles. Each candle, when you're looking at a Japanese candlestick, opens in a high or open, high, low, close formation. So that means the opening of a bullish candle is here. This is where it opened. This was the absolute high. The lowest was down here because this is a wick. Price action traveled that low and then rejected from there, and then ultimately closed up here. Okay, so I'm going to label this real quick. Just these two for you guys. So this is open, high, low, and then closes the same one as the high. Okay. And then we got fibs next, which is going to be super fun, guys. Open and then low. So then the opposite is true for a bearish candle, right? The open is going to be higher than the close because it's bearish. Price action moved down. So we're going to do open right here. And this is just like the absolute basics of reading price action. Open low, also the close. And then the high was here. Okay, so pretty straightforward. You guys, again, if you have any questions on this, guys, definitely drop it in chat. We'll circle back to this. But yeah, that's pretty much the breakdown of price action. Now, again, you're never just entering on one single candle or, if you see a bullish engulfing or a bearish engulfing, you're not just going to enter on that. You're trying to apply a lot of concepts. So one that we use, especially with this or with price action, is fibs, which is our next section that we're about to get into. I have creeping analysis. So Angelo, we're going to move over to fibs here. Feel free to chime in.
Yeah, no, I was just going to say, inside of the actual program, we get into, more advanced topics, the swing trading strategy, the intraday strategy, different indicators to use, right? Like much more high level stuff. But for the sake of this call, we want to keep things as basic as possible, as introductory as possible. I think that for anyone just going over these topics and hearing this again can be beneficial. And that's, again, one of the reasons why we even started this program, was because to master anything, right, to continually be reiterating these very basic concepts, that's like the foundation, the building blocks of mastery, of like achieving any level of greatness. So yeah, go ahead, get into the fibs. And once again, if anyone has questions, put in the chat. We'll cover in a little bit at the end of the session.
Awesome. All right. So the way that we use fibs, guys, we use it in a couple ways, usually or always with the trend. I'll get to that in a second. Then also we use it to determine structure and find potential entry zones. So let's go over the bearish example first. So this is a downtrend. We're looking to short this ideally, right? So we want to fib bearishly. So we're measuring from our highest lower high to the lower low and waiting for a bounce or some sort of reaction at two key levels that we look for. 38.2% level and 61.8% level. Now, this doesn't mean that you can't find rejection at other levels. These are just the two where we notice, the best rejections or the best play out of price action that we look for, right? That's what we're really looking to get to. 61.8 max, 38.2. This is where we find the healthiest structure, the most rapid movements, and quick profit. Opposed to a level up here, it could take a lot longer to play out. So that these are really the golden levels, as we call them. So again, we're measuring from lower high to a lower low, and then we're waiting for price action. This is a waiting game once we throw the fibs on, right? We're waiting to see price action react, where it's going to stop, and then we're reading price action to kind of get a jump on that, right? So let's say price action is coming back up. We get some sort of reversal signal here. Let's say it looks like this guy. We got tweezer tops, right? Right at this level, right near 61.8. And then we see two engulfings follow, or a bearish variation. So that means the example that we drew over here, where we get a couple bearish, strong bearish conviction candles following the rejection or following a reversal. That's where we're entering. So you would then enter on that and then target one of our negative fib levels, the 27 or 61.8. Now, I'm just going to size it up for visuals. Not going to get into it too much because there's a lot of other things like risk to reward that we could get to. But essentially, this is where fibs would come into play with price action and the trend, right? Nice pullback, rejection, and then that's how we'll play that trade out, and then we'll readjust the fib. So let's say price action plays out, pushes all the way down to the low. That trade is complete. We now have a new lower low. Boom, and then we move our fibs. So this was the original, right? Notice where 0% is. Price action exceeded 0%, pushed lower than it, right? So that means we redraw from the prior lower high to the new lower low. Mark 1, mark 2, and then we essentially start the process over again. It's now a waiting game. I'm going to use the path tool. It's now a waiting game, waiting for price action to pull back up and then continue if it does. Okay, this could definitely completely reverse, change structure, as Angelo covered in the first example. We'll get the next higher low above this lower high, and then we'll go bullish. So if that happens, how do we measure bullish fibs? We're going to do that right over here. We do the exact opposite as a bearish trend. We measure from the higher low to the higher high, and then we wait. Price action pulls back, hits 61.8. Now let's say here we got a whole bunch of indecision. So doji candles, low volume, no entry possible. And then we get a nice bullish variation. So three, large conviction candles in a row. These guys, just imagine three of those in a row right after a period of consolidation or low volume at a key level with the trend, and then we'll enter on that and then do the same thing, target the negative levels and then redraw the fibs if we exceed 0%. So there we did. Let's shift these up from the prior higher low to the new higher high, and then you repeat. There we go. All right. So, I mean, that's probably the most basic way I could describe it, just how to use the tool at least. Again, we could spend a lot of time really diving in, going through how to use fibs on different time frames. Normally, I'll focus fibs only on the time frame that I'm seeing for the week ahead, and for me, that's the 4 hour. So the 4 hour is going to show me the trend essentially for the week that I'm trading. I'll like to highlight that, find the structure points, and play on that 4 hour.
No, I think that's pretty much it.
Yeah, looks pretty good. All right, cool. So that's price action and Fibonacci. Just a quick run through, general overview, guys. But you can definitely ask us questions. Feel free to reach out. Otherwise,
yes, sir. All right, so that's pretty much all we're going to cover for the basics. We're going to move into kind of the second half of the webinar here, or towards the end of the webinar. And we're just going to talk about how do you know a trading strategy works. So we just went over a couple lessons. Those are kind of the foundations of how to build a trading strategy using just market structure, supply and demand, price action, fibs, multiple time frames. You put all of those together, or put 2 to 3 of those together, you can get confirmations, you can have a strategy. But how do you know that you actually have a winning strategy? This something that when I first started the program that I joined had talked nothing about this. But it's like anything else, you have to practice, you have to back test. And we've done so much of this back testing. When me and Nick first started hanging out, literally we would back test. Like that was like hanging out with us. Like it was insane.
We had like it was obviously a friendship, but it felt like a, you know, business relationship the way we were tackling it. And we just shared the same passion, and that's what we did.
Yeah.
We just
Yeah. It was all just
for hours.
It was literally all just, around the passion behind trying to figure out like how to actually become successful in this. And, you know, it definitely ended up benefiting us. There was like a 6-month period where we were just back testing almost like, you know, every single time we were hanging out. It got to the point where it was like really ridiculous. So we definitely took it to the next level. And now, how can you actually do that? How can you guys back test on TradingView? We're not going to hop onto it right now, but we do have videos inside of the program that teach about this. And also, obviously, if you guys are a part of the Telegram community, there are free videos on the YouTube as well that talk about this. But basically, TradingView has a tool, a replay tool. You can go back, you can choose a point at which you want to start at. Normally, what I'll do is I'll pick a period of time, maybe 1 month, where I'll decide to back test. Maybe I want to do the month of November. I'll pick a strategy that I want to use. Maybe I'm looking for market structure and supply and demand, and I'm looking at price action rejection of those supply and demand zones. Maybe I'm using fibs in comparison with market structure. You know, maybe I'm just looking for breaks and retests. Maybe I'm just looking for so on and so on, right? I'm putting together this strategy, or maybe I'm using a totally different strategy than what we just went over. Maybe I'm using the volume weighted adjusted profile, the VWAP, which is like the intraday strategy that we go over. Maybe I'm using some session volume, some other indicators that I'll throw onto the chart, and then maybe I'm back testing that. Now, depending on what strategy you're going to be utilizing, whether I'm doing the swing trading strategy or the intraday strategy. Swing trading, I know that I normally like to enter at the beginning of the week, right? I normally like to enter on Sundays, on Mondays, on Tuesdays. So if I'm back testing, I want to simulate that as much as possible. I don't want to be entering on a Thursday. I want to be entering on a Friday, right? I don't want to enter when the market's closed, right? I want to enter in as real of an environment as possible. So while I'm going through the test, I'm only going to be entering on maybe Sundays, Mondays, and Tuesdays, if that's what my strategy calls for. And the other days, I'm just going to let go by until I get back into those time frames when I want to actually trade. Same goes for the intraday strategy. Whenever I back test that, I know that I'm only trading the New York session. So I'm only back testing the New York session. I have strict rules. I'm only taking trades between 8 and 10 a.m. I'm not holding trades past 12 p.m., right? So I'm simulating that live environment. That way, when I get into a real situation, I'm getting into the real market, I'm literally just doing the same thing that I would be while I'm doing the back test, right? It's nothing new to me. And if there is something new, I'm taking note of it, or maybe I'm going back and I'm back testing that day. And as you can see, there's a lot that goes into trading, right? I'm back testing, then I'm testing it live, then I'm going ahead, testing it live. Maybe I'm discovering new market conditions because the market's always changing. And then I'm going back, testing again, and then going back and going live, right? So this is a cycle. This is like the habituals of being successful is literally continuing to change your strategy, continuing to test your strategy. That way you can continue to be profitable in the market. So that's how you know if a trading strategy works. You back test it, you get results, and then obviously you go live with the strategy. And the hope is to get results that are very similar to what the back test is. So that being said, I saw a lot of questions in here about kind of like trading psychology a little bit. What does it take to actually win at trading? Like what is your opinion, Nick, on what it takes to win?
To win at trading. So it takes dedication, because a lot of people are going to get discouraged in the journey. So you got to know yourself enough if you really want it enough that you're going to follow it through, get through all those hurdles, get through all those tests, and really immerse yourself. You know, I know pretty quickly when somebody reaches out to me if they're serious about trading, or if they're really willing to just do everything that's possible to make it work. And I think trading is definitely one of those things. You got to have the drive.
Yeah. In my opinion, I think what it takes to win is it's almost like the inverse of that word is you have to be willing to lose, right? So you have to be as comfortable with losing as you are with winning. You almost have to have this very neutral thinking about what you're doing, right? You have to be very even keeled. There's going to be highs, there's going to be lows. You have to be numb to those. You have to just stick to the plan. And if you have a plan, you're most likely going to become successful. And if you're not successful and you have a plan, it's because your plan is not good, right? So you need to improve your plan. That way, when you implement it, you actually do start to succeed. So one of the biggest things for me is just, you got to be able to handle losing. You're going to lose a lot with trading. If you can handle that, if you can face losing, if you can face the risks involved with risking your own money, then you will become successful. You'll win at trade. So we went over this a little bit at the beginning. How do I qualify for funding? So we're not going to go too much into it again, but basically the funding, you will take a two-step program, two-step challenge. You'll get an account for challenge 1. If you're able to trade within the parameters and hit the profit target, you will then get a second account. On that second account, you will have a little bit more time. The first one, you'll have 30 days. Second one, you'll have 60. If you can satisfy those requirements, once again, you will pass the second challenge, and then you will get a funded account. What does that mean, right? You'll get an account, you'll be trading that account, and any money you make on that account, depending on the firm, there's some firms where it's 70% profit split. Ours is 80%. There's others that are up to 90%, but you will get a split of whatever you make. And building off of that, because we are talking about treating trading like a business, there are taxes when it comes to trading, right? So trading, you're gonna get taxed as like capital gains. Talk to your accountant at the end of the day. I'm not a licensed accountant, right? So I'm not the best one to be speaking on this, but you will get taxed on your trading gains. This also does feed into why doing the funding challenges are better, is because you're categorized in a different way than when you're just trading your own account. So when you're trading with a firm, you're actually getting paid as a contractor because they're contracting you essentially for your data and then paying you for what you make. And then if you're trading your own account, you're getting categorized as a trader, and you have to pay short-term capital gains, which is obviously, or if you don't know, is a very high tax bill. So you could potentially be taxed lower with being a funded trader, which obviously is very important because it eats into your profits. That being said, there are always ways, if you do have a business, what are the advantages to actually trading or just starting your own business in general, is you're going to be paying your taxes at the end of the year, as opposed to when you're employed, your taxes are going to be taken out of every single paycheck. So there's no opportunity for you to potentially have some sort of savings in tax, or to expense things, to maybe buy things at the end of the year. And by buy things, I don't mean just buy anything. I mean responsibly buy things that you need, buy materials for your business, and then you can actually, quote unquote, get discounts on those materials by doing the write-offs and everything like that. But that's a whole other topic that we can get into. And we actually do, part of the funded trader, we have a licensed accountant that is partnered with us that you guys will be able to talk with and do your taxes with. You do get a discount as well. So that's Funded Trader Forex League. We're basically the same. So you'll be able to take advantage of that license account. So you guys do, at the end of the day, do your taxes correctly, but also do potentially get the savings that you need. So what are the advantages of your program? We went over a bunch of them. We're not going to get into the course too much. We could go on for another half hour about everything that's included in the course. I think at the end of the day, what we'll do is, if you guys do want more information on the course overview, there will be another page that you will go to. So you have to go to the next page, and then you guys will be able to watch the entire overview, and we'll run through the entire curriculum, everything that's included. The one thing that I do want to just highlight in here, because we did talk about funding a lot on this call, is because of the fact that Forex League is partnered with Funded Trader, we are the creators of Funded Trader. We do have, as part of our lifetime membership, discount codes so you guys can get funded through the Funded Trader, but we also have a free membership challenge. So for everyone that joins Forex League, they actually have the opportunity to get funded completely for free. Now, how this works is you're gonna go ahead and you're gonna actually take a challenge before you guys get involved in Funded Trader. So there are instructions on how to do this, but basically you'll create a demo account, you'll attach it to a tracking device, and then you'll post your link. I'm gonna just go ahead and go into the Discord so you guys can see some of our members actually posting their links in here. We had some members pass today, but basically they're all posting their links in here. They're simulating the first step of the challenge. So they're simulating phase 1. And if they are able to pass phase 1, we go ahead, we give you a 100% off coupon for a 50K challenge with the funded trader. So you can start with this free membership challenge and you can go all the way to being funded completely for free. And we actually did have one member today that wrote in here. He said, guys, I've just passed my phase 2. Thanks so much, Nick and Angela, for providing the opportunity. We have everything that we needed to become a successful trader right in this community. I wouldn't have passed this challenge if my psychology and risk management wasn't right, blah, blah, blah. So they passed the challenge, but they started off, if I were to search for Ali, he actually started off taking the free challenge. He got the free coupon code, and then he went ahead and passed. And we had a bunch of other people that passed the free one today, but I believe he is one of the first people that now is fully funded just from taking part in this program. So that's definitely one of the main things like that you're getting as part of the program. Again, if you do want more information on the actual overview, I'm not going to get too much into it right now. You can just go to the next page and you guys will be able to watch the full overview. That being said, this is pretty much the conclusion of the webinar. We're going to just run through a few questions. Again, we're doing a little bit of a giveaway. So if you want to get in, just post your questions inside of the chat. That being said, let's go ahead and just answer a few of these guys. Nick, if you see any you want to point out here, there's actually a lot of them.
Yeah, there's a lot. What psychological differences have you learned between trading through challenges and trading the funded account? So when trading any live money versus a demo, there are, psychological differences, even if they're not that apparent to you, they could just be happening as well. Because in your mind, a demo it's fake, right? You're being tested. You know that there's no money on the line. The only thing that's really on the line is the money that you spent on the challenge. But if you're a member, there really is nothing on the line. So that's actually something that we see is people don't take the demos as serious as they should. That could be attributed to just not having enough time in the market or, certain other psychological barriers. But there's definitely a massive difference between live and demo. For me, it actually took a lot of time before I could trade a large account, just to see those numbers fluctuate in front of me. It takes time. It takes time to become numb to it. I don't know many people that you could hand, a $200,000 account to that's either up 20 grand or down 20 grand and then be able to, make a nice logical decision. It takes a certain type of person to get to that point. That's what I think.
So that's a good one. Let's see.
What are the things you said we need for a good trading strategy? We did touch on this a little bit. If you want to just reiterate.
I would personally say the best way to go about this, guys, is if there is somebody out there that has a good trading strategy, it's good to build off of what they're doing themselves, right? You don't have to necessarily reinvent the wheel here. If people are using, again, a combination of fibs, supply and demand, trend lines, market structure, price action, anything under the sun, support and resistance, any sort of technical analysis, then it's most likely that you can build a profitable trading strategy with that. On the flip side, we didn't even speak much about EAs,
right,
and indicators in general, but you could also build a strategy like with an EA. You can find an EA that's relatively successful. If you did want to go that route of learning how to code your own EAs or partner with people who can build EAs for you, we have some members who have built EAs or have had their trading strategy like translated into an indicator or an EA that actually helps them trade. It creates zones for them, whatever. But I would just say using any of the foundational pieces that we gave you, because they're what's available to you, and then building off of that, connecting with other people, finding out what tools they're using, right? Don't go on the chart and just randomly search indicators or Google and like randomly just do things, right? Don't randomly search YouTube, watch 100 different videos, have some sort of direction in what you're doing, either go the route of using technical analysis, go the route of using expert advisors, right? Building an EA, using indicators, whatever, have some sort of rhyme and reason behind what you're doing here. Let's go to the next question. Do you think 1% per trade is too small? So we've preached this for so long now about trading with 1%, sticking to 1% per trade. There's people out there that really like risk their whole account on one trade, or they risk 10% or 20%, whatever. We have always been proponents of risking 1% per trade or even less, because even before the funding came out, it's like if the goal ultimately is to get capital, before funding, if the goal is to get capital, now with funding is to get capital. Think about if you get a 400K account, right, and you risk 1%, you could cross-check the math for me, but what would it be? 4,000 is 1% on a 400K account?
It's 40K. Is 10%. Is 10%.
Right, so it would be 4,000 would be 1%. Yeah. So literally, if you make 1% on a 400K account, it's $4,000, right?
Yeah, that's amazing.
It's a lot of money. We're not talking small money here. So if you make 5%, right, that's 20K that you're making on that account. So don't get FOMO, don't get fear of missing out. Don't try to risk more. We always have advised 1% per trade. We're going to continue to advise that. I think it's a responsible thing to do. I think if you guys really want, if you're out there, the next George Soros is out there, listening to this call. If you're out there and one day want to manage a fund, you want a huge hedge fund, you want to manage a huge amount of money. I'll tell you this: if you're managing 500 million and you risk 50% on one trade, like you're getting killed.
You'll never manage another account again.
like you're not gonna make it to sundown, right? So
no.
Even at that point, you're probably risking way less than 1%. So if it depends what the vision is. If you just want to flip that $100 accounts, you want to be that guy that just opens $100 account and tries to flip it to 1,000% all the time. Maybe that's you, But with Forex League, we've always just spoken about wanting to treat trading like a business, want to be as professional as possible, wanting to try to get more capital. And inevitably, if you're trying to get more capital, you're not going to be risking more than 1% per trade, most likely. And we've also seen on the funded trader that anyone that goes down more than 3% in any given day is almost 100% likely to lose their account. So take that in mind as well. It's a statistic from thousands of traders. So, if you're out there, you like statistics, there's the statistic. Don't risk.
Consistency is key. If you can't survive losses, your account's not going to survive it. In turn, you'll never pass a challenge. It's about surviving the losses. The best traders are the best losers.
Yeah.
So
it's and it's like, to be a winner, you have to fail at the end of the day. That's all winners are. They're just stare failure in the face and they just don't shake.
That's and just it. laugh right and move on.
It lasts forever. All right, next question here. Preferably, what session or time is the best to look for entries? London, New York, Asia.
Okay, so this is a great question. We talk about this a lot. So obviously, if you guys have been trading for a little while, the most volume is when the London and New York session overlap. Now, a lot of people like trading volume, volatility, especially if you're a little bit of a swing trader. You'll look to enter on those times, and then you'll hold the trade for a while. Normally in Asian sessions, over here at Eastern Standard Time, towards like 8, 9 o'clock, it's pretty slow. There's a lot of low volume. So if you think back to the price action section that we just covered, a lot of dojis, a lot of small indecision, no real direction. So it could be tricky depending on where you are located. You may have just more access to different sessions, maybe a Sydney session, Asian session. Those of you guys that are on the, more of the West Coast, you guys have more access to the London and New York. Definitely try and get as close to the New York or London as you can. Those are where you'll find the most movement. A lot of times, a lot of members will come to me in our one-on-one sessions and on other webinars that they're trading the Asian and they're not getting any movement, or they're stuck in a trade for a few hours before it, finally decides to make a move. And that's that's because of low volume, and that could throw a lot of people off. So definitely try to focus on New York, London.
Yeah, so next question, the rapid signal. So you'll get more of that in the overview video. But those that are interested, we do give signals as part of our program. We give trading alerts. The best way for me to communicate to you guys, and one of our members actually told me this a little while ago, and it made so much sense, is look at signals, any signal room. It's almost like your business is trading. Every business needs leads, right? To become successful. You need leads, you need to close those leads, you know, to be in your sales funnel, to get sales, to make revenue. With trading, it's the same thing. Joining a signal room is basically like getting leads. You're getting leads to trades, you're getting put on to alerts, to ideas from other traders. That being said, our rapid signal room has 5 to 7 traders, so it's not just me and Nick. There are other people in there. There's a lot of signals. There's about 5 to 10 being given per day. So there's more than one person giving trades out there, just to be clear. And we do have situations where someone said there was a buy signal on Forex open maybe today, you know, at 8 a.m. And then later in the day, there's a sell signal given. In that scenario, one, you should be looking at your own analysis, first of all, right? If your analysis lines up for buys and you're in you saw a signal come out for a buy, you should potentially stay in that buy, right? Say the next signal comes out as a sell, all of a sudden you're becoming unsure whether you should stay in the buy, stay in the sell. You should most likely close both immediately because you're uncertain as to what's going on. Now, another way to go about this is if you're in a buy in the morning, say the buy's consolidating, it's near break even, it's near the entry, and then a sell comes in, I would most likely switch from the buy over to the sell, and then, you know, that way you're in the direction of the most recent trade. Say the first trade is up a considerable amount of money, the sell comes in, I would close the first position, take the sell, right? Say you're in a buy, you're in a considerable amount of drawdown, a sell comes in, you know, I'd most likely, so long story short, second position is what you're going to use to determine what to do with your first position. You're most likely going to close that first position and transition over into that second position, unless you really are using this in line with your analysis. And if your analysis calls for buys, I don't care if, you know, Donald Trump comes and tells you to sell, right? Stay in the position, have some certainty around what you're doing. Well, maybe if he says to sell, but you get the point. Have some certainty in what you're doing, right? Ignore the noise, have some confidence. That's like what's most important in trading, is be confident in what you're doing here. So let's go ahead and answer like maybe 2 more of these questions. This is a good one.
Yeah, there's a lot here, guys. So, I mean, obviously we're not gonna be able to answer all of these, but you guys can jump into the Telegram chat or Discord or just message us, and I'd be happy to help you guys or answer some of these questions.
Yeah, for you guys watching this, the Telegram is the best place, or the Discord, to get in touch with us. Our support team is there, specifically in the Discord. You guys will be able to come in here. You can actually create tickets to get in touch with us, support requests. Right here, you can create a ticket, and then we'll get back to you as soon as possible. The Telegram as well, there's links in there where you guys can get in touch with us. But let's cover one more question after this one. First, how can you set a good stop loss? Because I mostly seem to hit the stop loss before the direction goes to my TP. So one, I just want to comment, always use a lot size calculator. The one that we use is called Nash Markets Lot Size Calculator. Use that one, look it up if you guys have not used it, but that thing can really help you out. You can use EAs as well that go under your chart or indicators. Those are good too. Some funding firms don't allow you to use EAs, and the Nash Markets one is not, it's separate, so you can always use that one. But what I will say about the stop losses is stop putting the stop loss too tight, right? If you're swing trading, put it in an area where the trade hits the stop loss, it is completely invalidated. I know everyone wants to get the best risk reward. They want the sniper entry, right? I think the sniper entry is actually a phrase that kind of died out a little bit. It like used to be more prevalent, but everyone wants this. Everyone wants the sniper entries, right? But don't do trades, right? There's so many times where even I've taken trades and my trade has hit stop loss and then gone right to my take profit. right? You don't want to be that guy. You don't want to be me in certain days, right? You want to put the stop loss in an area where if it hits, it's invalidated. You don't want to be in that trade anyway.
I think these last two at the very bottom are good. Do we still trade the markets or just focus on growth of the community? We are still very much active traders, right? I mean, as Angelo said, with the signals, we're in the signals room. We're putting out analysis every weekend, every Sunday, and then reviewing it. Very much still trading.
I would say, personally, I was trading a more intraday strategy several ago, and you guys can see that it's inside of the program. And I used to trade like live sessions every single day in New York, but ever since like the start of Funded Trader and just overall the growth of the community, I have had the transition from trading intraday to the swing trading. So every Sunday for the free community, we come on and basically do a Sunday market blitz. So we cover all of our analysis for the week. So that's mainly our swing trading analysis. That's when I'll decide to hop on positions on that call. So if you guys haven't come on to that call, I definitely recommend stop by the Sunday market blitz. Link is posted in Discord and in Telegram. And you guys will see, we've literally done the Sunday market blitz now for 2.5 years, every Sunday.
Yeah. Yeah, it's crazy. Every Sunday. It's like 2+ years. I think we're closer to 2.5 now. It's a lot of weekends.
All right,
Check it
we're
out.
gonna leave out Marco's, but the webinar is recorded, so we're not gonna write on here, but the webinar is recorded. You will be able to watch it later on. Last question here: why don't you start a fund and manage money? And we are starting a fund. We are managing money. That's kind of the whole purpose of everything that we're doing right now with the Funded Trader and with everything else. So without getting too into the details, that is really what we're doing, because it's always been the goal of ours from the beginning. So that is pretty much it. We do want to thank you guys for hopping on the webinar. We have a promotion that is available right now, 40% off for the lifetime program. So more details are going to be included on that. But if you do want to look at the actual overview of the course, you can go on. There'll be another page that you guys can go to. We're not going to get too much into the details of that, but we do thank you guys again for hopping on the webinar. There's so much that we can cover, so many tips and tricks and everything to go over. But again, all of that is inside of the community. Whether you're a free member or a paid member, you're going to benefit, from everything that is inside of there. So yeah, again, can't thank you guys enough for hopping on, and hope to see you guys in there soon.
Yeah, absolutely, guys. Thank you guys so much.